What's up, everybody? This is Sunko, the Korean bro. Today is 2023, March 13. And let's see. Okay. Hmm. SVB depositors will get their money, but Signature Bank also shut down. General Electric is getting ready to fire on all cylinders. Hmm. One overlooked opportunity for Warner Bros. Discovery is the stock a buy. Why bank stock investors are still scared. For only the fifth time in 153 years, this leading economic indicator is sending a terrifying warning to Wall Street. Mm, okay, let's see. SVB depositors will get their money, but Signature Bank also shut down. Bank regulators announced that New York State regulators had closed Signature Bank on Sunday. Hmm. Signature Bank customers will also get full access to their deposits, like customer of SVB. Customers of SVB have been concerned they may not get to access their deposits for some time. After a chaotic few days, U.S. banking regulators announced late Sunday that depositors at Silicon Valley Bank will be able to access all their funds on Monday morning, helping the bank's tech-heavy clientele avoid financial catastrophe. Hmm. The bank entered receivership on Friday after a trading of its parent company SVB Financial Group was halted. Regulators also announced similar protections for customers of Signature Bank. $110 bill in Asset Bank that was shut down by the New York Department of Financial Services on Sunday. The good news, depositors are to be made whole. Depositors at both Silicon Valley Bank and Signature will be able to access their funds Monday. In a joint statement, the Federal Deposit Insurance Corp, Treasury Department, and Federal Reserve said today we're taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. The three agencies added that no losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. Many of SVB's customers wondered what might happen if they couldn't access their funds this week to do things like meet payroll, pay bills, and fulfill other short-term obligations. The vast majority of deposits at SVB have been in excess of the $250,000 limit, not nominally insured by the FDIC, which is rather unique for the industry. In their statement, the three agencies also said shareholders and certain unsecured debt holders will not be protected, which is in line with Treasury Secretary Janet Yellen's statement early Sunday that there would be no government bailout. Senior management has also been removed, and any losses to the FDIC's deposit insurance fund to support these measures will be recovered through the FDIC assessment charges that banks pay every year. To help SVB and Signature pay out all of their deposits Monday, the Fed is creating a new bank term funding program which will make loans of up to 1 year to qualifying banks that will be co- characterized by various government-backed bonds. The Treasury Department is planning to use $25 billion from its exchange stabilization fund to serve as a backstop for the BTFP, although the Fed does not expect to have to dip into these funds. It's great news that depositors are going to be made whole on Monday. If they hadn't been, many young companies, both in the public and private markets, could have struggled or even outright failed. The bad news here is that another bank was closed, with regulators citing systematic risk. Hopefully, the fact that all depositors are covered will shore up confidence in the banking system. Another question is whether or not a buyer will emerge for SVB. Regulators have said that would be the best outcome for the failed bank, but they didn't seem to have a bar lineup as of a Sunday night. Hmm. Why bank stock investors were so scared? Markets initially applauded federal efforts to shore up banks, but those gains quickly reversed course Monday morning. Shares of Fire, Republic, and the Western Alliance were among the worst performers in pre-market trading. Even after the government stepped in to ensure depositors would get paid, bank shareholders aren't sure what to expect. Okay. Wall Street looks confused. Even professional investors don't seem certain how to handle the situation. Several analysts downgraded shares of First Republic, expressing fears about what the immediate future could bring for regional banks. Other analysts, however, saw the situation more favorably, with JP Morgan characterizing the sell off in First Republic shares as a dramatic overreaction. Some even suggested now was a great time to buy regional bank stocks. Going forward, the health of the banking sector could rely on the Fed. The central bank created a new program that will allow banks to take out loans using treasury securities and other high quality assets as collateral that could help financial institutions bridge the gap without having to liquidate their holdings at a substantial loss. For only let's go over to the next article, okay? For only the fifth time in 153 years, this leading economic indicator is sending a terrifying warning to Wall Street. One of the Wall Street's oldest economic indicators indirectly suggests the Dow S&P 500 and Nasdaq are nowhere near their respective bottoms. Multiple recession forecasting tools imply an economic downturn is imminent. Despite short-term turmoil, history conclusively shows that long-term investors have been handsomely rewarded for their patience. Perfect track record forecasting big trouble for U.S. economy and Wall Street. Hmm. A major warning is sounding on Wall Street for only the fifth time since 1870. Although M2 has a history of forecasting economic depressions or panics when declines by at least 2%, it's important to note that all these events occur between the 1870s and 1930s. The Federal Reserve has a far better understanding of how to adjust monetary policy to affect changes in the U.S. economy than it did 100 years ago. Similarly, the federal government's ability to use fiscal policy measures to support the U.S. economy is considerably more refined today than in the 1870s and 1890s. While numerous indicators suggest an economic downturn is forthcoming, a depression doesn't seem likely. Hmm. What's more, M2 was increased by a considerable amount during the COVID-19 pandemic, whereas a 2% or 3% decline in money supply spelled trouble a century ago. The expansion of M2 from $15.3 trillion to nearly $21.3 trillion between December 2019 and January 2023 may all force visible contraction without too much pain for the US economy. The point to be made is that even if an economic downturn is imminent, as so many indicators have suggested, smart investors will continue putting their money to work. Every year, market analyst company Cushman Research updates as historic data on what an investor would hypothetically have generated in total returns, including dividends paid, if they purchased an S&P 500 tracking index at any point since the beginning of 1900 and held 20 years. Okay. What Sophie stock investors should know about recent updates. Okay. Hmm. Apple, Paramount Global. Okay. Paramount Global. Why would he suggest Paramount Global? Setting aside Berkshire Hathaway's own share buybacks, Paramount Global has the distinction of being one of only four stocks purchased by the investment conglomerate in the fourth quarter. Buffett made his name in the investing world by using value-oriented strategies and pouncing on opportunities in which he seems stocks were trading below their intrinsic values. The investment in Paramount seems to be played in that classic vein. The media stock trades down roughly 80% from its peak, and shares look attractively valued at today's prices. Cloudflare is what we covered last time. Is there something interesting? Not here. Let's see what we have. Okay. First and foremost, the thing that I'm going to look at is. Hold on for a second. We'll see. Okay. Let's go look at Zuora. Zuora. What is Zuora? Let's see about Zuora. What is Zuora? Zuora. Okay, forget Dogecoin. These two tech stocks are better buys right now. Zuora. Many tech companies saw their valuation surge and investors turned to software-focused stocks amid the coronavirus pandemic. But gains for Zuora have been more muted. Software as a service stocks were generally huge winners over the last year as clients solved digital solutions to challenges created by the pandemic. But Zuora has traded roughly flat since the beginning of 2020. The company provides a software platform for subscription billing and sales recognition that makes it easy for businesses to implement and scale recurring revenue streams. More businesses are shifting to subscription based models because this approach helps with customer retention and tends to be more profitable over the long term. Growth for the subscription economy has already reshaped consumer and enterprise markets, increasing preference for recurring revenue streams to create long-term tailwinds for Zuora. On the other hand, the company has had a hard time bringing new customers on board its platform during the pandemic, and that meant its business and stocks have underperformed other SaaS leaders. The company leaders relies on large enterprises for the majority of its business, and large enterprises are often hesitant to adopt new business models and software platforms amid economic uncertainty. The good news is that the growth outlook appears to be improving, and Zuora trades at attractive levels for a SaaS company with big expansion potential. Zuora stock still trades down more than 60% from the lifetime high of $37.09 per share it hit in summer 2018, but the company's growth outlook remains promising. Shares look appealing at current prices, and there's good chance the stock will battle back and reach new heights. The company has had a market capitalization of roughly $1.6 billion and trades at approximately 4.7 times this year's expected sales. If you're looking for tech stocks that are primed for market beating performance even with valuations in the sector under pressure, Zora stands out as a top pick. Is there any other article that I can refer to? Okay, let's look at this one. The coronavirus pandemic was a growth catalyst for many software as a service companies, but it created a more difficult operating environment for Zora. The company's platform for implementing and automating subscription-based payment systems has a long runway for growth. But large enterprises are at its most important customer segment, and such businesses tend to avoid adopting new models and software systems during periods of economic uncertainty. That meant slowdown in new subscriber additions for Zora, and it started trading down by roughly 3.5% on the year after some big swings. Shares are now down more than 30% from their closing price on the day of the company's initial public offering on April 2018. While challenging economic conditions and lack of clarity about the future held Zora back in 2020, the good news is that the long-term growth outlook for the subscription economy has not been meaningfully disrupted. Its progress has merely been delayed. The rise of subscription-based models at both the enterprise and consumer levels over the last decade is far from a short-term trend. Companies have scrambled to recognize their businesses around recurring revenue streams because those models leads to more predictable sales performance and greater profits over the long term. This value-adding combination is bound to attract a growing number of business adherents, and Zora software offerings have the company in a good position to capitalize on the trend. The business should post better growth in 2021, and it wouldn't be surprising to see the stock make big gains. Okay, let's see about this one. Hmm. Shares of Zora have gained 2.5% over the past uh, weeks. Closed last trading session at $7.47, but there could still be a solid upside lap in the stock if short-term price targets of Wall Street analysts are an indication. Hmm. Why do you have to buy Zora? Zora, a company with a difficult to pronounce name, just went public. There's one good reason to think about investing in its stock, which was up 43% in first day trading on April 12th as of 11:40. Okay. Zora CEO Tenzo. Okay, let's look at the CEO. Or our time Mark benefit the billionaire founder CEO of Salesforce could not have accomplished what he did without finding and promoting great people. And one of the greatest turns out offers valuable insights into how the start at the bottom and rise to the top. The Stanford MBA should know, after all, Tien was Salesforce.com's 11th employee, and Benioff picked Tien to be its chief marketing officer. In his 9 years at Salesforce.com, Tien built Salesforce.com's original billing system, held executive roles in technology, marketing and strategy organizations. He built Salesforce.com product management, marketing organization, served as CMO for 2 years, and most recently as chief strategy officer. In 2017, founded SaaS billing service provider Zuora. Uh, in the June 2022 interview, Tien articulated 5 principles he has used to rise to the top and keep going. Always look at the bigger pictures to see where the opportunities are. It's not about seeking promotions, it's about how to be successful so that the promotion seeks you. Let's read this one. I came away impressed. Mark Benioff, the billionaire founder and CEO of Salesforce.com, hired the Stanford MBA who Benioff picked to be its chief marketing officer. In his 9 years at Salesforce.com, he built Salesforce.com's limit people to an area of expertise. He was more interested in someone who knew the issues facing the organization, someone who was adaptable and a learner, and someone who had proved he could get the job done. He knew I could get inside his head, understand the need, and make it happen. In the end, that's what a successful company will value. Tian's insight into how to grow as a professional and how to build a strong organization convinced me that he will be able to find ways to keep Zuora growing fast. Nevertheless, there are 4 things that would give me pause about investing in Zuora shares now. Let's see about this one. Losses are growing. Zuora is losing more money as it grows and plans to continue doing so. Its loss of $1.78 per share. Just so you know, this article was published in the year 2018. Hmm. Okay. Zuora business model canvas explained. Hmm. Okay, let's see. Let's look at video clip of Zuora and see how people think of it. Okay. Do people really think um, there are opportunities? Mm, wait, hold on. Zuora. Okay, there are many videos about Zora and its business model, but I'm just going to skip it at this point. As long as I know what kind of service they provide, then it's good with me. Um, what they provide is, just so you know, it's a program, subscription program that a lot of companies can use. Mm. With the with their service, every service out there, every company out there can uh, make their customers pay uh, monthly. Mm. It's more predictable. It's more efficient in terms of getting ready with uh, the service. Mm. That's what it is. Mm. But is subscription really the future business? Okay. The video clip that I just watched is about the future business. Future business that we can expect is a subscription model, because with subscription model, people can expect, and like um this does disadvantage of this is that you will never ever own stuff, but then you will just use their service, but then you can use a lot of them, efficiently, uh, at the right place at the right timing. Anyway, I feel like I don't talk much today, but like I'm a bit tired. We talked about Zora, then we'll talk about something else tomorrow. Okay, I'll see you guys. Bye bye.